I think the economy is going to slow down, and when the economy slows down, the Fed recognizes this and will stop raising interest rates. And at the same time, it removes a key leg for the dollar. It's not that the news stream is really much better in Europe or Japan. It's just that the news stream from the U.S., I think, has been driving it, and we should see it. We should see the dollar pull back further. The biggest risk for Americans is not in China. It's not in Russia. It's not on the West Bank. It's not on the Gaza Strip. But it's here at home. We, I think, are our own worst enemies.
Marc Chandler, Chief Market Strategist at Bannockburn Global Forex and author of the blog Marc To Market, and also author of the books Making Sense of the Dollar and Political Economy of Tomorrow. It is so great to welcome you on the show. Thank you so much for joining me today, Marc.
Thank you. Thank you for inviting me.
Well, I'm excited to have you on. And I got to say, one of my viewers actually wrote in the comment section that I should invite you on. And I love to listen to them because I got to say, they do have some amazing guest recommendations. So I'm just thrilled to have you here today. And Marc, just to kind of fill you in on the show and where we like to start, we always like to kick things off with the macro view, the big picture. So I'm going to give you some time to set the table, if you will. If you could provide us with your macro view on not only the economy, but also let's do it in two parts. Let's also do the markets as well.
Sure. Thank you. And, my job is often involves the capital markets, broadly speaking. And I find that the foreign exchange market is like a window picture rather than a keyhole view of the world. The foreign exchange market is what's really has kept me motivated throughout my career, more than 30 years. And, what's exciting about it is it's a $7.5 trillion a day market. $7.5 trillion is really a mind-boggling number. Put it in perspective for you, world trade in a year is about, call it about $40 trillion, which means that we do that in a week in the foreign exchange market. World GDP, everything the world produces, all the goods and services, is about $100 trillion a year. And we do that in about 3 weeks in the foreign exchange market. My week, like foreign exchange participants generally, begins off really Sunday afternoons when Australia opens up. And it really finishes around 5 o'clock on Fridays when U.S. banks, New York banks are no longer responsible for making prices. And so it's a 24-hour-a-day market, and all the things that affect stocks, interest rates, commodities also can be expressed in the foreign exchange market. And so we speak today as the dollar has had an incredible rally. And we could talk about the short term, but really put it in big picture perspective. The dollar has been on a tear, trending higher really since the end of the great financial crisis. So it's been more than a decade, which is another reason I like foreign exchange. It seems to me in the stock market, you need a new opinion like every week or every 2 weeks. But the currency markets just trend for a long time. And I think that the dollar's rally is, if it's not over yet, it's nearly over. I suspect that it really ended last September when we had that crisis in the UK and sterling fell to a record low of about 103.5. At that time, the euro was around 96.5 cents or so. I think that was just an extreme, just an extreme move. And that this year we've been consolidating. The dollar's pulled back a bit, but again, it's been strong more recently, partly as the market thinks that, one, the Fed may have to be more aggressive on raising rates. Two, the U.S. economy, it's really a question of divergence. It's not that the U.S. economy doesn't have its problems. We all know about a lot of the problems, but every place else looks worse. Europe is barely growing. Japan's economy, the world's third largest economy, actually contracted in the second quarter if it wasn't for tourism, which is, of course, helped by the weak yen. So as we sit here today, what concerns me, or in the big picture, what really touches me is that when we look at, currencies, my friends in the crypto space are correct. The dollar is not backed by gold or silver. So valuation is difficult. And economist types have come up with a valuation method. And there's very complicated ones, but I like the keep it simple, stupid method, the KISS method. And And that's sort of more intuitive to a lot of people. And you can see it in the Economist magazine. They say they look at the Big Mac as their proxy. And the idea of purchasing power parity is that a basket of tradable goods should sell for the same price when you make the currency adjustments. And to the extent they don't, it shows a misalignment. And whether you do with, The Economist has done it with Big Macs, Starbucks got cappuccinos, but the Organization of Economic Cooperation and Development, the OECD, sort of a club of large, rich countries. They have their own model of purchasing power parity. And this might be maybe another way of thinking about it, sort of like the other night, my wife was out of town and I was watching these mixed martial fights on TV, which I only watch when she's not around. And they said this one small guy was actually stronger pound for pound than one of these big guys. And it's the same thing in the currencies. We adjusted, instead of pound for pound, purchasing power parity. And by this measure, the euro and Japanese yen are the most undervalued that they've been in my career, which goes back to the Plaza Agreement back in the late 80s, when mid-80s, 1985, when the G5 countries at the time met at the Plaza Hotel in New York and said the dollar had risen too far, and they intervened and sold it in a coordinated fashion. So the dollar now is overvalued by more than it was then against the euro and Japanese yen. And typically, these OECD currencies, right, they're not emerging market currencies. Typically, they don't move more than plus or minus 20% away from fair value. The euro and yen are 50% undervalued. And I think that the dollars, what's had lifted the dollar is coming to an end. And what's lifted the dollar is Fed tightening. And whether we've got one more Fed hike left or not might not matter that much. We're at the tail end of the Fed's move. And I think that and why will the Fed be done? Partly because inflation's falling, and I think that the economy is weakening. And I know a lot of your listeners have heard a lot of economists talk about a recession coming, and they've been talking about it for 2 years. And there's a big capitulation this summer. A lot of the big economists threw in the towel and said, okay, we're not having a recession. And that is what sort of excites my contrarian instincts, because I sort of see a lot of headwinds headed to the U.S. economy, and we're going to begin seeing them. Actually, I think we've already begun seeing them in last Friday's jobs data. Even though the headline was roughly twice what the market was expecting, below the surface were some troubling signs. For example, U.S. economy has lost full-time jobs for 3 consecutive months. A big jump in a big part, like 2/3 of the rise of jobs that were reported for September, were people who were considered self-employed, non-contracted. And I think that's a fancy word for gig employees. Because what happens, we see from the weekly jobless claims, people are not collecting unemployment benefits so much. It's relatively low. So it seems to me what happened is people either quit or lost their jobs one way or the other. And instead of collecting unemployment benefits even though in the U.S. we have a relatively weak social safety net compared to other high-income countries, there still is a large stigma attached to collecting unemployment benefits. So what people did who lost their jobs, they became gig workers rather than collect unemployment benefits. That's what it looks like. And the third thing about the jobs data that signaled to me some weakness is the number of people, which is kind of mind-boggling, who have 2 full-time jobs, a record high. 2 full-time jobs. And of course, that's because their jobs don't pay or might not give benefits. And so people have to make ends meet and they're struggling. But we're going to see this weakness of the economy when we begin getting next week's economic data, which will include retail sales, industrial production, existing home sales, housing starts. Most of these data points will show that the economy has lost a lot of momentum at the end of Q3. And Q3 is kind of interesting, right? Because, there are a lot of people want to figure this out for themselves. And where can we go to look for GDP estimates? Well, I find the Atlanta Fed, they have this thing, the Atlanta Fed is this GDP Now tracker. So rather than being an economist and try to forecast, imagine you approach the economy just as an accounting function. As the data comes in, what does this mean for growth? And the Atlanta Fed, you could Google this, the Atlanta Fed is looking at 4.9% growth for Q3. I think this is as good as it gets. And we're going to see a sharp slowdown in Q4. We've got a tightening of credit conditions, which we all know about, right? As the Fed has raised interest rates, banks have been have reduced the sort of tightened up credit rules, and borrowers are not so anxious to borrow at these elevated interest rates. But also we've got the resumption of student loan payments, student loan debt servicing. It's going to squeeze consumption. We also have, even though oil prices have come off recently, they're still relatively elevated, and that's really a tax on consumers. The more money that we spend to heat our house or to cool our house, as the case may be, and to fuel a car, the less we have to spend on other things. So economists draw a distinction between a general increase in prices and a relative increase in prices. And I would note that most of the U.S. downturns, recessions, the end of business cycles, have often been, in the U.S. modern times, has often been preceded by a sharp rise, often a doubling of the price of oil. So what does this all mean? It means I think the economy is going to slow down, and when the economy slows down, the Fed recognizes this and will stop raising interest rates. And at the same time, it removes a key leg for the dollar. It's not that the news stream is really much better in Europe or Japan. It's just that the news stream from the U.S., I think, has been driving it, and we should see it. We should see the dollar pull back further.
Wow. Marc, I got to say, that was fantastic. And that's why I love this show so much, and getting to understand the picture and a different lens from the Forex lens. It's so helpful. I have a few follow-on questions, and I got to say, I'm definitely not a Forex expert, so you're helping all of us learn in the process. I was taking some notes, and I wrote down about the dollar being overvalued. I would love to hear more on that, and also kind of piecing this together. I guess with the Fed's rate hikes, and that's been a leg for the dollar. Can you just help us kind of understand maybe some of the consequences of maybe an overvalued dollar, the consequences there, and if it comes back or pulls back? Just want to hear more on that, and I imagine it does have some effects.
Sure. I think in many ways the dollar is one of the most important foreign exchange price. It's really, I think it's one of the most important prices that the economy generates, partly because, as I was mentioning, the market for capital is so much bigger than the market for goods. And you think about market for goods as trade or GDP, and the capital markets, currencies, money markets, bonds, cross-border movement of money is so much greater than the market for goods. And so I focus on those things that drive capital rather than driving goods, especially for large economies like the U.S. And so as a consequence, so for me, there's two aspects of the price of money, right? The foreign exchange price of the dollar and interest rates. They are both elements of the price of money. And it does seem to be a relationship, even though that relationship might not be linear. So, for example, high interest rates don't always mean a strong currency. If that was the case, that emerging markets would have very strong currencies because they have very high interest rates. That's typically not the case. Countries don't give high interest rates because they're generous. They give high interest rates because the market demands that from them to compensate for some other risk: inflation, political risk, institutional risk, various types of risk get priced in. And so partly what's happened then is that the overvalued aspect of the dollar, one of the things it means is cheaper imports, which partly means that the COVID really messed up our trade figures. A big surge of imported goods, and then the imported goods, we don't want the goods anymore, we want services after COVID ends. And so it messes up our trade figures. But the rise of the dollar helps curb inflation, and the Federal Reserve has cited that as a factor dampening inflation. It also affects, and we're going to see this as we get Q3 earnings coming up in the coming weeks, that many companies who will disappoint. I saw on Bloomberg a note saying that roughly half of the public traded U.S. companies are losing money. And why are they losing money? Well, some of them will say that's because of the strength of the dollar. Because what the strength of the dollar means is that their foreign earnings, the money that they earned in Europe or Japan or elsewhere, when they convert it back into dollars, it doesn't buy as many dollars. Hence the earnings squeezed. And you can also appreciate that a stronger dollar reduces the cost of buying those foreign goods. And so that also helps push down inflation. But this distortion, I think, is creating a great opportunity for US dollar-based investors. With the assets in Europe and Japan so cheap, I think that we as Americans or dollar-based investors should begin thinking about diversifying more of our equity investments or fixed income investments to Europe and Japan. Already we're seeing the very rich guy in Omaha talking about buying more Japanese assets. And I think that the same kind of logic is that over time, and it takes years for this big misalignment in currencies to adjust. And for dollar-based investors buying Japanese stocks or Japanese bonds or European stocks or bonds, that the currency adjustment will act as a big tailwind for them as this process adjusts. Whether we get the timing right this year or next year, I think that's fairly safe to think that's going to happen in the next several years, that this huge misalignment in the currency markets will adjust, and it'll benefit Americans to have some diversification overseas.
That is fascinating. That's a really interesting point. I wonder if there's almost been a bias to be more U.S. invested, and sounds like it's opening up an opportunity, like I guess a window to allocate outside of the U.S.
Yeah, so I think that's right. I mean, I think that it creates a lot of misalignments in the market, create opportunities, I think, and the currency misalignment seems extreme to me. Extreme based on my experience, extreme based on the historical, like how far does that rubber band stretch between value and price? And I think that when things are so extreme, I think that's where the opportunity is. And for European and Japanese investors who have bought U.S. stocks over the years, this might be a time to take profits either on the portfolio investments or actually on some direct investments. And we see some European companies have already sold some of the U.S. assets to American private equity or venture capitalists.
Hey everyone, thank you for listening and watching the show. I do want to share something with you all. And if you've been here since earlier this year, you've probably noticed that this channel and the content that we're putting out has improved. And I'm not talking about the interviews, I'm talking about the quality of the production. And I have one person to thank for that, and that is my wonderful producer, Matt Marlinsky, who is the founder of Marlinsky Media. So if you're someone like myself and you want to get started in podcasting, or maybe you already have a show and you want to level up the production, you have to work with Matt. Not only is he a super talented producer, he is a wonderful person, and there's no one I would rather build this show with than him. And he's also great when it comes to producing content. So if you already have content, he can help you create more short form to grow your audience. So definitely go check out Marlinsky Media. Okay, back to the interview. Let me ask you this. On the recession front, and this we've been talking for 2 years. I think that's what you said, that 2 years of expectations of a recession. Why do you think we haven't seen it in the U.S.? Why do you think we didn't see it sooner or haven't seen it sooner? And I want to hear more on your expectations for a recession and what might push us into one.
Yeah, sure. It's funny about a recession. I think it's one of the things that my love-hate with the economics as a discipline. There's no real definition of recession that people agree on. And partly it makes sense if you understand it historically. Before the Great Depression, things were called, the end of a business cycle was called depressions, panic, or crisis. But after the Great Depression, the powers that be wanted not to ever have that experience again, of course. And so they wanted to separate the word. They needed another word to distinguish an end of a business cycle from the Great Depression. So they came up with this word recession. And the rule of thumb that people had used for a long time was 2 quarters of negative growth. And that's what the U.S. had in the first half of last year. But it didn't really feel like a recession, partly because the contraction of the economy wasn't because of the domestic economy. It was because of 2 other factors, trade and inventories. And so economists like to strip those out anyways to get to like final demand, final domestic demand, sometimes private demand, excluding government as well. And so what does it really mean that the business cycle ended? I think it means that you have and this is why in the U.S. we don't even really use that definition of 2 back-to-back quarters of contracting growth to define a recession. It's a much broader definition of recession. And so why hasn't the U.S. experienced a recession that so many economists have called for? And I think that what surprises people is 2 factors that have helped explain why we're not in a recession. One is the incredible government spending. And think about what this means. So the U.S. economy, roughly this year, about a $1.8 trillion deficit. $1.8 trillion. And it's just a large amount, especially now in the past. It's not uncommon for the U.S. to have a large fiscal deficit during times of recession or some kind of crisis. It makes sense, right? In a crisis or recession, your revenues are weaker because people aren't paying as much taxes because they're not earning as much profits. And the government has to have more money, expenditures for counter-cyclical unemployment compensation, for example. And so one of the things that have kept us out of a recession, I think, is the strength, the bold fiscal spending in the Biden administration. Whether we like it or not, the idea is that it's extreme for an economy that's growing, that's not in a recession. So very strong government spending. And secondly, and you see this, you saw this in last Friday's jobs data as well. Wage growth in the U.S. is above the rate of inflation, which is remarkable. That means that many of us have experienced a real wage increase, real meaning adjusted for inflation. And that's what's helped underpin the U.S. consumer. And of course, it's not just that we have above inflation wage growth, but also many of us have maxed out on credit cards. And you can see this in the delinquency rate of credit cards is rising. I like to draw the distinction between wholesale and retail because, you know, that beautiful outfit you're wearing, I'm sure you paid a retail price for it, just like the tie I have, I paid retail for it. I know someone else, the store I bought it from, paid wholesale. Most of us are familiar with that when we go shopping as consumers. But the same thing works for money. There's a wholesale and retail price for money. And if you don't know the difference, it tells me you're probably paying the retail price. The wholesale price of money is what banks charge each other. Right now, that's about 5.5%. My credit card charges me 21.3%. That's the retail price for money. In the same way, it works in the currency markets too, which really amazed me because I realized that there was a wholesale and retail price for money, but I didn't realize how big it was. For example, when we look at the euro, we say the euro is traded at 1.0600. That means we trade the euro to a hundredth of a penny spread between the bid and the offer. The large pools of capital, large asset managers, hedge funds, corporations, they're actually paying, there's another decimal point that you and I don't see. That's what they're paying. That is a thousandth of a penny spread between the bid and the offer. And of course, when you're doing billions at a time, it adds up. What I found is I had spent most of my career helping the large asset managers and large companies. And a few years ago, I joined Bannockburn, which helps small and medium-sized businesses. And we look at what those small and medium-sized businesses are paying. They're not paying a thousandth of a percentage point. They're not paying a hundredth of a percentage point. They sometimes are being forced to pay 3 and 4% spread. That's the retail price of money in the foreign exchange market compared to the wholesale money, thousandths of a penny spread. And so, it's for me, it's an important aspect of how the money works. Is that there's a retail and wholesale price for money, just like there is in other things that we buy. And sort of like watching those poker games on TV, that short stack is at a disadvantage. And the same thing in the capital markets, where the undercapitalized participant is at a disadvantage.
Yeah, it's so fascinating to hear. Okay, another question, and this might be a bit of a naive question, okay? I was listening to you talking about like the government spending, the deficit levels, which is extreme for an economy not in a recession. And my naive question is, Why not just let the business cycle just play out naturally? Would it be kind of healthy to let it do that? I don't know. Maybe that's a bad question, but
no, I think a lot of people ask that. They don't understand why. It's sort of like during the Great Depression, a Treasury Secretary, I think it was Mellon, who said, liquidate, liquidate, liquidate as the answer. And instead, we don't allow that process to fully play out. Partly, I think this is what modernity means. It means that there's a high safety net, and that we don't want. I think where policymakers, not just in the U.S., but say in our generation of policymakers, have done a great job of not getting rid of the business cycle, but reducing the amplitude, so it's not quite as high highs or low lows, and it's longer. And I think that's ultimately what we want. And the problem, I think, that you point out is that by not allowing the business cycle to run its full course, we basically pile up debt on top of debt. And I think that's a concern for a lot of people. And it's hard even for me. I don't see how the game ends. Like, what's the end game in all of this? And so I do see that, like in the past, when you have a deep down cycle, deep contraction, that it washes out a lot of the inefficient and bad luck people. They have to default, go bankrupt, or worse. And I think that ultimately these big swings in the business cycle aren't good either. A lot of waste takes place, and so I think that we're sort of struggling. And I think this is you raise an important point too. I think there's an idea that a long period of stability. Imagine a long period of rising equity prices. Why that leads to a crisis, and it has to do with financial engineering and people. Like, imagine what happened back in the early part of the 2000s. People thought house prices could only go up, so they took on more debt to buy the house. Prices could only go up, and banks were happy to make these loans. We called them ninja loans. No interest. No income. No job, no assets, ninja loans. And the reason that banks would make these kind of loans, the same reason why they might loan to some, oil patch in Texas, is not because they think they can get the money back, that the business could be successful. But they think, the banks thought at the time in the early 2000s, so what? They collect the house as collateral, and house prices only go up, they thought, just like households thought. And of course they don't, and oil doesn't only go up. So one thing to lend to an oil patch when you got $100 a barrel of oil. Another thing when oil falls back to $70 or $60 a barrel. And so I think that it's a different type of lending that takes place. And I think that this idea, this called the Minksy moment, is when this long period of stability leads to its opposite, instability. And I think that's what people are worried about. Libertarians especially worried that the government is protecting us from ourselves. And that leads to some kind of like moral hazard. I tend to think it's a bit exaggerated. I don't think people purposely take on more debt because they think the government's going to bail them out. But I hear that as a common pushback. And I am also concerned about like how this game ends when we just build debt on top of debt on top of debt. And so I'm not sure it's sustainable, but it's one of those things that I don't see how it ends, and I don't see a political will to end it. Part of this is the democratic representative governments, but it's not just that they have to keep the voters happy by preventing us from hurting ourselves too much. But even countries where we're more critical of their lack of democracy. I think about these authoritarian regimes that also want to provide a better living standard to their people, and also take actions to promote economic strength, even if they're not, democratically represented.
Yeah. Do you think we're headed for a Minksy moment, or do you not buy that argument?
Yeah, so I don't know. I mean, I think that we had the Minksy moment. I think that's partly what happened 2008, 2009. I think the COVID crisis is a lot different from that. Could we have another Minksy moment? Sure, but I think that the markets have been too volatile. It's not like the stock market rallied strong in the first part of the year and given a good chunk of that back. Bonds have been in a bear market for 2 years now. So I'm not sure we've got the makings of a Minksy moment, because asset prices, stocks, bonds, houses, aren't just going straight up. And I think you need to have that long period of stability, which unfortunately we haven't had.
Yeah. They not just on the debt and the deficit and like not knowing the end game or anything. I was just pulling up the U.S. Debt clock. There's just a website, you could see it all just ticking higher and the interest on the debt and all of that. I'm a millennial, and yeah, you said you don't know the exact end game, but I guess if you had to think about it, like how much of a worry is that? Just kind of like our fiscal picture, if you will.
Yeah, it comes to debt. I think Americans have a different attitude. In German and in Dutch, the word debt and guilt have the same root word. We're not Puritans. Well, we are Puritans in America, but not when it comes to debt. And I think that in the U.S., the rule is OPM, other people's money. Isn't that with the credit card? Many years ago, they tried to have, they had debit cards in Europe. They tried to introduce debit cards in the U.S. It didn't really fly. It really only was acceptable to people who don't have income, who can't borrow, use other people's money. So out of all the things that I worry about, I sort of take Ronald Reagan's attitude about the deficit. It's big enough to take care of itself. And by that I mean the U.S. deficit is U.S. dollars. We owe it to ourselves. And so, and people are concerned. I think, remember what happened last September in the UK? Newly elected, a new government comes into power. They want to have this huge fiscal expansion. And the markets went on strike. Capital went on strike. They said, we're not going to buy your bonds. And it led to a big sell-off in UK bonds. And the Bank of England had to step in and buy bonds to help stabilize the market. So here we are with this huge deficit in the U.S., and yet, and this week, as we're speaking, the U.S. has its quarterly refunding, where it's going to be selling literally billions of dollars of bills and billions of dollars of coupons. And yet, each of the auctions are going to be oversubscribed. That is, if the government is selling, say, $45 billion, there'll be people who want to buy, there'll be orders to buy $90 billion. I don't see the U.S. I don't see the U.S. in a fiscal crisis now. And I think that, of course, bond yields have risen, bond prices, that means have fallen, and people who bought those bonds during COVID, we saw that earlier this year in March with the banks who bought the bonds, who didn't maybe hedge them properly or did adjust their portfolio accordingly, or maybe relied on deposits that proved more fickle than they thought. But we are seeing some strains from the rising interest rates. But at the same time, the demand has been strong. And what we've really seen happening is, for a long time, people who wanted to buy U.S. government T-bills or government bonds, they had to go to the broker. But now the Treasury has made it so that retail people like you or I, can just go onto the Treasury's website and buy a bond or a T-bill directly from the Treasury. They take the money right out of our account, and when the issue matures, they put the money back into the account with the accumulated interest. And so I think yes, people who bought bonds before are underwater. But I'd say that the speculative community, looking at the futures market and what they call the non-commercials, the speculators, have a huge short position in the U.S. bond market, betting on higher interest rates. But many of us on the retail side, who are used to getting zero interest on our savings, now we can go into the money markets, or we can buy T-bills directly from the Treasury, getting call it 5.5% or so on a 3-month T-bill. And so I do think that the debt is a problem, but not yet. It might pinch us, as you say, the more money, as interest rates rise, the debt servicing costs are rising, and that takes money that could be used for something else. Instead, we have to pay people who own the T-bills, the bonds. It is a concern, but It's happening, though, in the context of, like I say, a strong U.S. dollar. So that tells me that the money that's leaving the U.S., foreign investors who might be selling U.S. bonds, are leaving the money in the U.S. So, for example, some of my friends talk about how China has been selling U.S. bonds. They may have. I'd want to take valuation into account given how much they've sold off. But what looks like to me like what China is doing is as much treasuries as they've reduced, they bought agency bonds, giving a bit better of a yield. Some people tell me that, well, Japan has adjusted their yield curve control. They had capped the 10-year yield at 25 basis points until the end of last year when they moved it up to 50 basis points. And then at the end of July, they moved it up to 100 basis points. And people said, Japanese investors will keep their money at home. But they haven't. Whether it's the TIC data, the Treasury's International Capital Flow Report that comes out the middle of every month, or whether it's the Japanese Ministry of Finance, who has a weekly report. The Japanese have been net buyers of foreign bonds. And that would include, of course, U.S. bonds. And so, to me, yes, they have been selling. Of course, we can see bond prices have fallen, yields have risen, but the money has been stayed in the U.S., and that is reflected in the strength of the U.S. dollar. So no crisis. I think it'd be a bigger issue if bonds were still selling off and the dollar began selling off. But we're not at that point. And in fact, I'm kind of thinking the opposite, that yields are near a peak in the U.S., and I think the dollar is near a peak. And when interest rates begin falling on a more sustained basis, the dollar comes off, I think.
Yeah. Well, Marc, I've been enjoying this conversation. I just want to sneak in maybe one, maybe two questions. So maybe we keep these a bit more brief. What for you is the biggest risk on your mind, the one that is top of mind for you today?
Yeah, sure. And for me, the biggest risk, it sounds kind of funny because, here we are a few days after a horrible strike in Israel from the Gaza Strip. We're in the middle of a war, Ukraine and Russia, after Russia's invasion almost 2 years ago. Other parts of the world look very dangerous in Europe. People think there's an arms race in East Asia. Maybe China is sort of eyeing Taiwan. But I suspect, as we speak here today, that the biggest problems America faces, my biggest worries, are all homegrown. Longevity in the U.S. is falling. Longevity. People are not living as long in the U.S. anymore. And this began before COVID. I think we're averaging about one mass shooting a day in America. These are serious problems. The teenage suicide rates. These are problems homegrown. I don't think we can blame Moscow or Beijing or whomever. These are homegrown problems. And the same thing with when I think about the role of the U.S. economy, the role of the dollar. Many people talk about de-dollarization. To me, rather than encroachment, rather than another country trying to eat our lunch, I think the bigger risk is abdication. We Americans either act or purposely or otherwise act as if we don't care anymore. Pull back from the world, use these sanctions, think about what's happened. Not only the U.S. and our allies not only froze Afghanistan assets, central bank assets, we also froze Russia's central bank assets. And it's not just that we froze them. That might be, it's a war. That might be acceptable. But what we're talking about now is repurposing them. Taking the money that we froze and respending it, whether it's to rebuild Ukraine. Noble thing, rebuild Ukraine. Or for the victims of 9/11, take that money from Afghanistan. But I think that is a very dangerous precedent to set on the world stage. I think that the U.S. created, or I should say was instrumental in creating, the post-World War II order, not only Bretton Woods, but the World Bank, the IMF, the UN. We used to call it the GATT, the General Agreement to Talk and Talk, and now it's the WTO. These are post-World War II institutions that helped provide rising living standards for a huge swath of the world's population. And now we are backing away from those institutions in different ways. We make commitments. For example, most recently, the Biden administration and Treasury Secretary Yellen helped negotiate international tax reform, which included a minimum tax on corporations. And now after negotiating this and getting other countries to make concessions, it doesn't look to me like we have the political will to sign it. It's almost like what happened after World War I. Remember at the time, Woodrow Wilson, the president, has the 14 points League of Nations, advocating it. The world joins the League of Nations except for us. And that's what's happened for several other treaties. And so to me, the biggest risk the biggest risk for Americans is not in China, it's not in Russia, it's not on the West Bank, it's not on the Gaza Strip, but it's here at home. We, I think, are our own worst enemies.
Yeah. One final question. I heard you briefly mention when we were talking about the valuation of the dollar, your friends in the crypto space. Are you a crypto person? Do you like Bitcoin? Do you have a viewpoint on cryptocurrencies?
Well, I have played around a little bit, and by a little bit, it means I haven't lost too much money. But I don't think that, I think of crypto the way I kind of thought about the moral majority. There was a group in the US, they weren't really moral or they weren't the majority. Crypto is only money because it says it is. It's sort of like people I know who tell me that they profess their religion, and do they go to church? No. Do they believe in God? No. But they tell me what religion they are, and it's self-disclosed. And I think that at the very heart of crypto is a contradiction. It really goes on this economic law, Gersham's law, which is basically that bad money chases out good. So here, you or I might have in our electronic wallet, we have some Bitcoin or some Ethereum, and we also have in our other wallet US dollars. So if the idea is that dollars are being printed by the Federal Reserve and the Treasury like they're growing on trees, then we should use those to buy our goods, and we should hoard crypto. And that's exactly what people are doing. They're not using crypto to buy things. I mean, of course, occasionally you hear about somebody trying to buy a real thing with crypto. That's not really what's happening. You can see the relative stability by looking at by some of these studies that look at the IP addresses. And so what happens then is because crypto is being hoarded, it's not being able to develop the networking effect that needs to be money. Economists mean something very specific by money, 3 elements: a store of value, a means of exchange, and a unit of account. Of course, things are not priced in crypto, so it's not really a unit of account. It's as a store of value, what's behind it? I'd say behind the US dollar, the reason the dollar is a reserve asset is because of the US Treasury market. Transparent place where people that is public as well as private can save money. Imagine you're in Japan, you've got an 80 basis point 10-year bond yield. How do you retire? And so crypto, I think, it's just a currency. And these days I can get, as I mentioned, 5.5% on a 3-month US T-bill. What does crypto pay? No yield. And so it's at a bigger disadvantage in a rising interest rate environment. And I don't think it's really as I mentioned, it's not really a means of transactions. So I have some comic books for when Clark Kent, not Superman, but Clark Kent proposed to Lois Lane. The comic book is worth something like $10 now. I've got a stack of them. I cannot give them to my grocer. I cannot give them to my landlord any more than I can give them some crypto. They won't know what to do with it. And in the space that I work in with small and medium-sized businesses, what the treasurer is trying to do is manage their currency risk. Accepting crypto for their product or their service gives them a new currency risk. They're trying to reduce risk. And my friends in the crypto space want them to take on new risk. So I think crypto is an interesting innovation. To me, it's another evidence, if you will, another piece of evidence that there's too much money. And too much money, you say, well, there's a lot of debt. And to me, you got to remember that when the Treasury issues a bond, that becomes a liability for them. But it's an asset on my balance sheet. In my retirement account, that Treasury bond is an asset. So debt, assets and debts are just which side of the balance sheet you're looking on. And so I think that the thing here is that crypto is neither. And I think it's an interesting experiment, but I'm not sure, just like we talk about the U.S. debt and deficit, not sure how that story ends. I'm not sure how crypto ends. I do remember, I'm old enough to remember when the internet was first launched and people would add .com to their names and the valuation would go up. And I know many of my friends have enough stock shares of these companies, of these old internet companies like Pet.com, to wallpaper their house. And I think the same thing's going to be true with the crypto space. Interesting experiment, but I'm not sure what the end game is.
Yeah, well, I have to say, fascinating conversation. Marc Chandler, Chief Market Strategist of Bannockburn Global Forex. Thank you so much for being so generous with your time and your ideas. Really appreciate you taking the time to come on, Marc.
Well, thanks a lot for having me. These are these big picture issues that are not just good for cocktail conversations, but these are how many people have to make their living and try to protect their pension money.
Exactly. And you're helping all of us learn. I got to say, I took so many notes in this conversation, and I just appreciate you. Thank you again.
Thank you.